Hey, it's Jeff Garber, mortgage expert and mortgage interest rate guru, coming at you on Wednesday, February 2nd, 2022 with a mortgage interest rate update for this week. So last week we were talking about, the consequences of Russia attacking Ukraine and how that would cause the stock market to sell off, which it did. And when the stock market sells off, investors are taking their money and putting it into the safe haven of the bond market, which also happened. And in the bond market is where mortgage rates live. 30-year fixed mortgages are traded every day in the bond market. And as we have green candlesticks, meaning as the price of mortgage bonds go higher, mortgage rates come lower. Well, if you see Friday, Monday, Tuesday, you can see a big rally in the bond market. And look, not that we're excited about this, the unintended consequences of Russia attacking Ukraine, which is a horrible thing. And if we had our way, we would, wish that never happened. But it did happen, and you're seeing the result of that right now, meaning there's a rally in the bond market, and rates came down a nice amount over the last few days. We basically gained all of what we lost back a few weeks ago, February 9th, when the Fed spoke, and we realized that inflation was, going to be a big problem. I think we already knew that, but the bond market didn't like that, and we had a big bump up in rates there, about 0.25%. Since then, we've been trading in a pretty big trading range, and again, once Russia went into Ukraine, that was last week. You can see the bond market reacting positively, meaning price was going up and rate was going down. All was good until last night, State of the Union, and today we wake up and the bond market's giving back now some of the gains that we got over the last few days. And the reason why the bond market is giving back is really basically all due to inflationary comments that were made by the president at the State of the Union, mostly having to do with oil. Bottom line, prices at the pump are going to go up. All right, that's inflation. And as I've said before, and I'll say it again, inflation is the kryptonite to the bond market, specifically mortgage-backed securities and the 10-year Treasury, two of the securities in the bond market that we follow. So due to the fact that oil is going to cost more and gasoline at the pumps going up, and that's inflationary, the bond market didn't like that today, so we're giving a little bit back. But not the end of the world. We still had some nice gains over the last few days, and so we're giving a little bit of it back, and now we have to watch and see. I think it's going to be a tug of war each day here based on what happens in Ukraine and what happens with sanctions, because when we impose sanctions on other countries, while our main intent is to punish the other countries, there are unintended consequences, a lot of it economic driven. And so some of the things that we're doing could actually, make our situation a little bit worse, especially when it comes to inflation, which is something that we feel the Federal Reserve is going to start to try to get ahead of at its next Fed meeting in March. But right now, we're not in a bad place, relatively speaking, for mortgage rates. We're still at historic lows. We just given a little bit back from yesterday. We'll see how the rest of the week plays out, and I will follow up next week with an update. And if you have any questions or comments, you want to schedule a 15-minute chat with me, just click my link below. I'd be happy to discuss any of this with you or anything else related to mortgages. All right, we'll catch you next week.